Hello everyone, this is Dr.Mihir Shah once again with another video. In this video, we are going to solve April 2019 University question paper under the subject Security and Portfolio Management, also known as SAPM. Again, a very important video for all the TYBBI Sem 6 students. Okay, so what all various practical question had appeared in this particular video, in this particular paper, all those sums will be solved. So let us see one by one what sums have been asked and how to solve them in the most easiest manner. Okay, now the very first question which was given in the paper was the rate of return of stock alpha and beta under different status of an economy are given below. Okay, they are given you three periods. We have boom period, normal period, and recession. Probabilities are given. Return of stock of alpha is given. Return of stock of beta has been given. Calculate the expected return and standard deviation on both the stock. If you can, either invest in one of them, but not in both, then which would be the best and which stock would you prefer? Okay. So they have given you like a case study kind of sum. So now first thing we need to first find expected return. Now expected return के लिए so first we'll do for alpha and then we'll do for beta. Okay. Now expected return के लिए you need only two things. You need probability and you need return. Okay. So the first three columns will be like for alpha it will be first is the particular, so we have boom period, normal and recession. Then we have probability 0.35, 0.50 and 0.15, and then the return 30, 50 and 70. Now, in order to find the expected return, the formula is very simple. You just have to multiply probability into the return. So P into R. So you multiply, okay, 0.35 into 30, 0.5 into 50, 0.15 into 70, and we'll get the values as 10.5, 25, and 10.5. These are point, okay. So the total value that you should get is 46. That is nothing but your expected return, 46%. So our expected return is 46%. Now, in order to find standard deviation, we need few more columns. So the next columns will be R minus R bar. So R is your return, R bar is your expected return. The 30 minus 46 is negative 16. 50 minus 46 is 4. 70 minus 46 is 24. Next column will be R minus R bar the whole square. The square of whatever we have got. So 16 square is 256. 4 square is 16. 24 square is 576. Last, P into R minus R bar the whole square. Okay, the what value we just now got, multiply that with the value of probability. So we'll get 89.68 and 86.4. Total comes to 184. This is nothing but the variance. Now the standard deviation is the root of variance. So standard deviation is root of P into R minus R bar the whole square, that is root of 184, which comes to 13.56. Okay, so this is how we found the expected return, that is 46%, and standard deviation 13.56 of alpha limited. In the same way, we'll have to find for beta limited now. Same order. Okay, first for beta it will be probability and return. Probability is given 0.35, 0.5, 0.15. Their returns are 70, 50 and 30. We multiply them. So we got 24.5, 25 and 4.5 came to 54. So our expected return is 54%. Once we get that, then we do R minus R bar. So 70 minus 54, 50 minus 54, 30 minus 54. The square of that, and then you multiply with the probability to get the total of variance, which came to 184 again. So standard deviation is nothing but the root of variance, so it came to 13.56. Now if you look carefully, in the previous, in alpha, the expected return was 46%. Okay, and for beta it is 54. Standard deviation was same for both. So if you have to invest in any of the one, we would have invested in beta because the rate of expected return is higher and the risk is same. So my final conclusion will be, okay, the stock which would we prefer to invest will be stock beta. Okay, so this is how you all had to solve this question number 2 for 15 marks. So I hope everyone have understood. You just need to remember the formula and the format. Okay. Chalo. After this, the next question which was there in the paper was question number 3. That was also 15 mark. Following information is available relating to X limited and Y limited. X limited ka equity, X and Y ka equity share, profit after tax, proposed dividend, market price per share, current asset and current liabilities are given. They're asking you to find earning per share, PE ratio, dividend payout ratio, return on equity shares, and current ratio. And as an analyst, inform the investor which is good in investing. Okay. Now, first thing we need to find earning per share. So, earning per share ka formula is profit after tax minus preference dividend upon number of equity shares. So, earning after tax or profit after tax, either way. Okay. So, we have profit after tax. Okay. Preference dividend is not there because there's no preferential sum. Okay, divided number of equity share. So equity share for X, it was 300 divided by 10, so it comes to 30, and 350 divided by 10 comes to 350. The profit after tax was 50 and 70 respectively. So for X limited, okay, it is 50 minus 0 upon 30, which came to 1.66. For Y limited, it is 70 minus 0 upon 35, which came to 2. So earning per share is 1.66 and rupees 2. Next, PE ratio. PE ratio का formula is market price of the share upon earning per share. Market price is given 200 and 280. So 200 upon 1.66, that is the earning per share we already found. And 280 divided by 2. So it came to 120 times and 140 times. Third, dividend payout. Dividend payout का formula is dividend per share upon earning per share. EPS we already have, but dividend per share we don't have. The dividend per share का formula is the proposed dividend divided by the number of shares. So in our first X के लिए it will be 35 divided by 30, which came to 1.16. So 1.16 upon 1.66 into 100 is 69.87%. And for Y limited it was 40 divided by 35, that came to 1.14. So 1.14 divided by 2 into 100 came to 57%. Next is return on equity share. Formula is PAT minus preference dividend upon equity fund into 100. Profit after tax is given for both 50 and 70. Preference dividend not done. Equity fund is 300 and 350 respectively. So 50 minus 0 upon 300 into 100 is 16.66%. 70 minus 0 upon 350 into 100 is 20. So the return on equity share of X is 16.67 and 66, and for Y it is 20. And the last one was current ratio, that is current asset upon current liability. Both the values have been given, 80 upon 40 and 90 upon 45. So the current ratio for both is 2. Okay. So this is how you all had to solve this particular sum. So in the sum, basically, you all only have to remember the ratios. Okay, there are plenty of ratios that you need to remember. But once you have the ratio, you have to substitute the values in the ratio and get the answer. So this is how you all had to solve. Okay, they had asked for 5 ratios and we have got. So now if you have to comment on each of them, as per earning per share, Y limited is better. As per PE ratio, Y is better. As per dividend payout, X limited is better, gives you a higher dividend payout. As per return on equity share, Y is better. And as per current ratio, both are under the same bracket. Okay, so you'll have to comment on each one of them. Okay, so this is how you'll have to solve question number 3. I hope everyone have understood that. After that, the next question which was there was question number 4a. The details of 3 portfolios have been given. Return on Sony, Moni, and Tony, and market index has been given. They are giving you return on portfolio beta and standard deviation. Compare this portfolio on the performance of using Sharpe and Trenor measure, and risk-free rate of return is 8%. So we'll first start with Sharpe's measure. So Sharpe's measure ka formula is return minus risk-free return upon standard deviation. So for Sony, return is 18, risk-free return is 8 by default, that is for all. Upon standard deviation is 28. So we divided, we got the value as 0.35. Okay, these are index forms, so percentage sign is not required. You don't need to put this in the index form. Okay, same way for Moni, it will be 12 minus 8 upon 32. Then for Tony, 16 minus 8 upon 36. And for market index, 14 minus 8 upon 22. So the value that we got is 0.35, 0.125, 0.22, and 0.27. So as per Sharpe's measures, the portfolio of Sony is way better than the others. Same way for trainers, we have to apply the trainers ka formula. We'll first note down. It is a similar formula. You have a return minus risk-free return. The only thing is it is upon beta. So 18 minus 8 upon 1.2, 12 minus 8 upon 0.8, 16 minus 8 upon 1.1, and 14 minus 8 upon 1. So when you divide, again percentage is not required because this is all in the index form. So as per Trenor's measures, the highest value which you all are getting is again for Sony portfolio Sony. So Sony is the better choice among both for sharpest measure and Trenor. Okay, the portfolio Sony is way more profitable than others. Okay, so this is how you'll have to solve the sum based on sharpest and Trenor's measure. After that, the next question which was there in the paper was, okay, now the next question was question 4b. A Government of India bond of rupees 1000 each has a coupon rate of 7.5% per annum and a maturity period of 10 years. If the current market price is 960, find YTM. Now the formula, first we note down the whatever data has been given to us. So they are giving you face value 1000, market value 960, interest rate is 7.5 and number of years is 10 years. Okay. YTM is I, that is interest, plus face value minus market value upon n into 100 upon face value plus market value upon 2. So interest 7.5% on 1000 is 75 plus face value is 1000 minus 960 upon 10 into 100. The whole thing upon 1000 plus 960 upon 2. When you solve it further, it will become 1000 minus 960 is 40 upon 10 is 4 and 1000 plus 960 divided by 2 is 980. So we get 75 plus 4, 79 upon 980 into 100 and final answer comes to 8.06%. Okay, very simple sum. You just have to remember the formula and then just substitute the values in that formula. Just remember I is always on the face value. Okay, that was question number 4b. And now one last question which was there in this paper. The returns of Alpha Limited and Orange Limited are given for 4 years with market return. You are required to compute the beta of Apple Limited and Orange Limited. So we are asking us to find the beta. We'll first start with, now remember beta is always return when you're comparing the return with the market return. Okay. So first we note down the years. This is for Apple Limited. First we note down the years, we note down the return and we note down the market return, get the total. Total comes to 46 and 56. Next, we need to find R bar and RM bar. That is nothing but the average. So 46 upon 4 and 56 upon 4 comes to 11.5 and 14. Next columns that will require will be R minus R bar, that is return minus R bar, and R minus RM minus RM bar. So RM, all the return on market minus RM bar. So 11 minus 11.5, 13 minus 11.5, 12 minus 11.5, 10 minus 11.5. Similarly, 12 minus 14, 14 minus 14, 14 minus 14, and 16 minus 14. Once you get these two values, multiply them, we'll get a next column, that is R minus R bar into RM minus RM bar. There's no square or anything on it, okay? So you multiply, we get these value and get the total because that total is important. So it comes to -2. And last column will be RM minus RM bar, the whole square, the square of that one column and the total of that, which comes to 8. Once you all have got that, okay, once you all have got that, we just have to apply into three formulas. First, covariance. Formula is R minus R bar into RM minus RM bar, the whole thing upon N minus 1. So we have already got that -2 upon 4 minus 1, that is 3. So 2 divided by 3, 0.66 is our covariance. Next, we need to find standard deviation square M. That's in the formula. So that is Rm minus Rm bar the whole square upon n minus 1. So 8 upon n minus 1, that is 4 minus 1, 3. When you solve, you get 2.33. Final formula is beta is equal to covariance upon standard deviation square M. That is 0.66 negative upon 2.66. So we get the beta as 0.24 negative. Okay, that is for beta, that is for Alpha Limited, sorry, Apple Limited. Same way, same order we'll have to do for Orange Limited. Okay, now same way for Orange Limited. First, we note down the number of years, the return of Orange and the market return. Get the total, we get 50 and 54. We find R bar and RM bar, 50 upon 4 and 54 upon 4. We get 12.5 and 13.5. Okay, next will be R minus R bar and RM minus RM bar. We take all the return minus with the bar that we have got. Then we multiply these two columns. Okay, we get the value as negative 5.5, and then we get the square of Rm minus Rm bar the whole square. Okay, so we get the values as, okay, the total comes to 9. Once we get that, we need to first find covariance. So that will be negative 5.5 upon 4 minus 1, so which comes to negative 18.33. Then we need to find standard deviation square m, that will be 9 upon 3, which comes to 3, and then beta is equal to 18.33 upon 3, which comes to negative 6.11. So among the two negatives, the first one was little lower. Okay, so there are both are negative. So if you have to comment on the returns of the beta, we'll say both are under the negative returns. Okay, the both the betas are negative. So these were the various questions that had appeared in April 2019 question paper. Okay, I hope everyone have understood that. So with that, we will be ending this video here. Thank you.